Welcome to Relockium's comprehensive course on risk management and trading. Our goal is to equip you with the knowledge and skills you need to optimize your trading strategy and avoid falling victim to scams. Trading can be an exciting and potentially lucrative activity, but it is not without risk. No matter how skilled or experienced a trader is, there is always a chance that a trade will go against them and result in losses. Unfortunately, many people fall victim to scams and fraudulent schemes in the trading world, which can further amplify the risk involved. That's why risk management is such a crucial aspect of successful trading. By understanding and implementing risk management strategies, traders can protect their capital and achieve long-term success in the markets. This course will provide you with a comprehensive overlook of risk management, including key concepts, tools, and strategies that you can use to manage risk effectively. At Relockium, we are committed to helping traders avoid scams and achieve their financial goals. We have seen firsthand the damage that fraudulent schemes can do to people's lives, and we believe that education is the best defense against these types of scams. That's why this course not only covers risk management, but also emphasizes how to avoid scams and fraudulent practices in the trading world. Throughout this course, we will cover a variety of topics related to risk management, including understanding risk, position sizing, stop-loss orders, risk-reward ratio, and risk management strategies. We will also provide real-world examples and practical tips to help you implement these strategies in your own trading. By the end of this course, you will have a solid understanding of risk management and be equipped with the tools that you need to protect your capital and achieve long-term success in the markets. We hope that this course will empower you to take control of your trading journey and avoid falling victim to scams and fraudulent practices. Thank you for choosing Relockium as your trading education provider. Let's get started on your journey towards optimized risk management and successful trading. Welcome to the first topic of Relockium's comprehensive course on risk management in trading. In this lesson, we will provide you with an overview of risk management, including what it is, why it is important, and how it can benefit your trading journey. So, what is risk management? Risk management is the process of identifying, assessing, and mitigating risk in order to protect capital and achieve long-term trading success. In other words, it's about minimizing potential losses while maximizing potential gains. Why is risk management important in trading? The answer is simple. Trading is inherently risky. No matter how skilled or experienced a trader is, there is always a chance that a trade will go against them and result in losses. Without proper risk management, a series of losing trades can quickly wipe out a trader's entire account balance. However, by implementing effective risk management strategies, traders can protect their capital and minimize losses, even during times of market volatility or unexpected events. This allows them to stay in the game and continue to trade, even when faced with challenges. So, how can risk management benefit your trading journey? For one, it can help you maintain a consistent approach to trading by setting clear rules and guidelines on managing risk. This can lead to more disciplined trading and less emotional decision-making, which can help to minimize the impact of cognitive biases and behavioral errors. Additionally, proper risk management can help traders avoid the common pitfall of overtrading, which can lead to excessive risk-taking and poor performance. By focusing on risk management, traders can stay grounded and maintain a long-term perspective on their trading goals. In this course, we will cover a variety of risk management strategies and techniques, including understanding risk, position sizing, stop-loss orders, risk-reward ratio, and more. We will also provide practical examples and real-world scenarios to help you apply these strategies in your own trading. We believe that risk management is a crucial aspect of successful trading, and we are excited to share our knowledge and expertise with you. We hope that by the end of this course, you will have a solid understanding of risk management and be equipped with the tools that you need to protect your capital and achieve long-term success in the markets. Thank you for choosing Relockium as your trading education provider. Now, let's dive into the world of risk management. Welcome to the second chapter of Relockium's comprehensive course on risk management in trading. In this chapter, we will discuss the different types of risk that traders face in the markets. When it comes to trading, there are several types of risk that traders need to be aware of. These include market risk, credit risk, liquidity risk, operational risk, and more. Understanding these risks and how they can impact your trading is a crucial part of effective risk management. Let's start by defining market risk. Market risk is the risk of losses due to changes in market conditions, such as shifts in interest rates, changes in currency values, or changes in commodity prices. Market risk is inherent in all forms of trading and can be difficult to predict or control. Next, we have credit risk. Credit risk refers to the risk of losses due to a counterparty's inability to fulfill their financial obligations. In other words, it's the risk that the party on the other side of the trade will default on their payments. This risk is especially prevalent in the futures and options markets, where traders are exposed to the creditworthiness of their counterparties. Liquidity risk is another important type of risk. Liquidity risk refers to the risk of not being able to sell an asset quickly enough or at a fair price. This can occur when trading in markets with low trading volumes or when trading highly illiquid assets. Liquidity risk can be especially relevant for traders who need to exit positions quickly or who trade with large positions. Operational risk is the risk of losses due to failures in the trading process, such as technological glitches, human error, or fraudulent activities. Operational risk can be mitigated by implementing effective risk management procedures and maintaining robust internal controls. There are also several other types of risk, such as legal risk, political risk, and more. The key is to identify and understand the types of risk that are relevant to your own trading activities and to develop appropriate risk management strategies to mitigate them. In this chapter, we have provided an overview of the different types of risk that traders face in the markets. By understanding these risks, you will be better equipped to develop effective risk management strategies to protect your capital and achieve long-term success in trading. Thank you for choosing Relockium as your training education provider. In the next chapter, we will discuss the importance of understanding risk-reward ratio in trading. Welcome to the third chapter of Relockium's comprehensive course on risk management and trading. In this chapter, we will discuss the importance of understanding probability and risk in trading. Probability is a fundamental concept in trading, and it's critical to have a solid understanding of it to make informed trading decisions. Probability is the likelihood of an event occurring, and it can be expressed as a percentage or as a decimal. In trading, probability is used to determine the likelihood of a trade's success or failure. Risk, on the other hand, is the potential for loss. Every trade involves some degree of risk, and it's important to understand how to manage that risk to protect your capital and maximize your returns. Understanding the relationship between probability and risk is critical to effective risk management. Traders who understand the probabilities of success or failure for their trades can make informed decisions about risk management and position sizing. Let's start by discussing the basics of probability. In trading, probability is often expressed in terms of win rate or probability of profit, POP. Win rate refers to the percentage of winning trades, while POP refers to the likelihood of a trade being profitable. For example, let's say you have a trading strategy that has a win rate of 60%. That means that out of 100 trades, you can expect 60 of them to be profitable. Similarly, if your trading strategy has a POP of 70%, that means that there is a 70% chance that a trade will be profitable. It's important to note that win rate and POP are not the same thing. A trading strategy can have a high win rate but a low POP if the winning trades are small and the losing trades are large. On the other hand, a trading strategy can have a low win rate but a high POP if the winning trades are large and the losing trades are small. Once you understand the basics of probability, you can start to apply it to your trading. One of the most important applications of probability in trading is position sizing. Position sizing is the process of determining how much of your account to risk on a trade based on the probability of success and the potential risk-reward ratio. For example, let's say you have a trading strategy that has a 60% win rate and a risk-reward ratio of 1 to 2. That means for every dollar you risk, you stand to make $2 in profit. Based on this information, you can determine how much of your account to risk on each trade. To calculate position size, you can use a formula that takes into account your account size, the risk of the trade, and the distance to your stop loss. By using this formula, you can ensure that you are not risking too much on any one trade and that you are maximizing your potential returns. Another important aspect of probability and risk in trading is understanding the concept of expectancy. Expectancy is a measure of the average amount of money you can expect to make or lose on each trade that is based on the probability of success and the potential risk-reward ratio. To calculate expectancy, you can use a formula that takes into account your win rate, your average win size, your average loss size, and your risk-reward ratio. By calculating your expectancy, you can determine the profitability of your trading strategy and make informed decisions about risk management. In conclusion, understanding probability and risk is critical to effective risk management in trading. By understanding the probabilities of success or failure for your trades, you can make informed decisions about risk management and position sizing. By calculating your expectancy, you can determine the profitability of your trading strategy and make informed decisions about risk management. Thank you for choosing Relockium as your trading education partner. In the next chapter, we will discuss the importance of setting stop losses and how to use them effectively in managing risk. Stay tuned for more valuable insights and practical tips on risk management in trading. Welcome back to Relockium's Risk Management in Trading course. In this chapter, we will be discussing one of the most important risk management tools in trading, the stop loss. A stop loss is an order placed with a broker to automatically sell a security or asset when it reaches a certain price level. The purpose of a stop loss is to limit the trader's loss on a position if the market moves against them. Many traders fail to use stop losses effectively, which can result in significant losses and even account blowouts. In this chapter, we will discuss the importance of setting effective stop losses and provide you with some practical tips on how to use them in your trading strategy. First off, it's important to understand that stop losses should not be arbitrary or based on emotions. Instead, they should be based on sound, technical analysis, and a clear understanding of the market conditions. A stop loss should be set at a level that makes sense based on the market's volatility and your own individual risk tolerance. It's also important to avoid setting stop losses too close to the current price level, as this can result in premature exits and missed opportunities. Conversely, setting stop losses too far away from the current price level can increase the potential loss on a trade and result in larger drawdowns. Another important consideration when setting stop losses is the use of trailing stops. Trailing stops are stop loss orders that are adjusted as the market moves in your favor, allowing you to lock in profits while still protecting your downside risk. In addition to using trailing stops, there are several other techniques that traders can use to set effective stop losses, such as using support and resistance levels, using technical indicators, and using multiple time frames to confirm the market trend. At Relockium, we believe that effective risk management is essential for long-term success in trading. By using stop losses effectively, you can limit your downside risk and increase your chances of success in the markets. That's it for Chapter 4. In the next chapter, we will be discussing position sizing and how to determine the optimal trade size for your account. Thank you for watching, and we'll see you in the next chapter. Welcome back to Relockium's Risk Management and Trading course. In this chapter, we will be discussing the importance of position sizing and how to determine the optimal trade size for your account. Position sizing is a critical component of effective risk management, as it can help you manage your risk and maximize your returns. The goal of position sizing is to determine the appropriate amount of capital to allocate with each trade, while taking into account your overall risk tolerance and the potential losses which may occur. One of the most important principles of position sizing is to never risk more than you can afford to lose. This means that you should always consider your account size, risk tolerance, and the potential loss on a trade when determining your position size. For example, if you have a $10,000 trading account and you are willing to risk 2% of your account with each trade, your maximum risk per trade would be $200. There are several methods that traders use to determine the optimal position size, such as fixed dollar risk, percentage risk, and the Kelly criterion. Each of these methods has its own advantages and disadvantages, and it's important to choose the method that best suits your trading style and risk management goals. The fixed dollar risk method involves risking a fixed amount of capital on each trade. For example, if you decide to risk $100 on each trade, your position size would be determined based on the stop loss of the trade. The percentage risk method involves risking a percentage of your trading account on each trade. For example, if you decide to risk 1% of your account on each trade, your position size would be determined based on the size of your trading account. The Kelly criterion is a mathematical formula that helps traders determine the optimal position size based on their edge and win rate. This method takes into account the probability of winning or losing a trade and adjusts the position size accordingly. In addition to determining the optimal position size, it's also important to consider the potential rewards of a trade. This can be done by setting a target price or a profit target and using this information to calculate the risk-to-reward ratio of the trade. The risk-to-reward ratio is a measure of the potential profit versus the potential loss of a trade. By setting a profit target and using this information to calculate the risk-to-reward ratio, traders can determine whether a trade is worth taking based on their overall risk management goals. By using effective position sizing techniques and considering the risk-to-reward ratio of each trade, traders can minimize their downside risk and increase their potential returns. Proper position sizing is essential for long-term success in trading and can help you manage your risk effectively while maximizing your profits. At Relockium, we believe that position sizing is a critical component of effective risk management. By using these techniques, you can ensure that you are managing your risk effectively and maximizing your returns. Welcome back to Relockium's Risk Management and Trading course. In this chapter, we will be discussing the importance of diversification in trading and how it can help you manage your risk and increase your returns. Diversification is a risk management strategy that involves spreading your capital across different assets and markets. By doing so, you can reduce your exposure to any single asset or market and minimize your downside risk. Additionally, diversification can also help you capture opportunities in different markets and increase your potential returns. There are several ways to diversify your trading portfolio, such as investing in different asset classes, trading different markets, and using different trading strategies. Let's take a closer look at each of these methods. Investing in different asset classes involves allocating your capital across different types of assets, such as stocks, bonds, commodities, and currencies. Each asset class has its own unique risk and return characteristics, and by investing in multiple asset classes, you can spread your risk and potentially increase your returns. Trading different markets involves diversifying your trades across different markets, such as stocks, futures, options, and forex. By doing so, you can take advantage of different market conditions and capture opportunities in different markets. Additionally, trading different markets can help you reduce your risk by avoiding overexposure to any single market. Using different trading strategies involves diversifying your trades across different strategies, such as trend following, mean reversion, and breakout trading. By doing so, you can reduce your risk by avoiding over-reliance on any single strategy, and potentially increase your returns by capturing opportunities in different market conditions. However, it's important to note that diversification is not a guarantee against losses. Even with a diversified portfolio, there is always the risk of market volatility, unexpected events, and other factors that can impact your investments. Therefore, it's important to continually monitor your portfolio and adjust your diversification strategy as needed. At Relockium, we believe that diversification is a critical component of effective risk management. By diversifying your portfolio across different asset classes, markets, and strategies, you can reduce your downside risk and increase your potential returns. In the next chapter, we'll be discussing the importance of risk-reward ratio to protect your capital. Thank you for watching, and we'll see you in the next chapter. Welcome back to Relockium's Risk Management and Trading course. In this chapter, we will be discussing the concept of risk-reward ratio and how it can help you manage your risk and increase your profitability. The risk-reward ratio is a measure of the potential profit and loss of a trade. It compares the amount of money that you stand to lose if the trade goes against you, the risk, to the amount of money that you stand to gain if the trade goes in your favor, the reward. For example, if you risk $100 to potentially make $200, your risk-reward ratio is 1 to 2. A good risk-reward ratio is essential for effective risk management in trading. A high risk-reward ratio means that your potential reward is greater than your potential risk, making the trade more attractive. A low risk-reward ratio means that your potential risk is greater than your potential reward, making the trade less attractive. To calculate the risk-reward ratio, you need to know your entry price, stop-loss price, and target price. Your entry price is the price at which you enter the trade. Your stop-loss price is the price at which you exit the trade if it does go against you, and your target price is the price at which you exit the trade if the trade goes in your favor. When setting your stop-loss and target prices, it's important to use technical analysis and market conditions to determine the most appropriate levels. Additionally, you should consider your overall risk tolerance and trading strategy when setting your risk-reward ratio. A good rule of thumb for risk-reward ratio is to aim for a ratio of at least 1 to 2, meaning that your potential reward is at least twice your potential risk. However, this can vary depending on your trading strategy and risk tolerance. At Relockium, we believe that understanding and implementing a good risk-reward ratio is critical for effective risk management in trading. By using a positive risk-reward ratio, you can minimize your losses and maximize your profits, while maintaining a consistent approach to risk management. Welcome back to Relockium's Risk Management and Trading course. In this chapter, we will be discussing hedging and how it can be used to manage risk in trading. Hedging is a risk management strategy that involves taking an opposite position in a related asset or security in order to offset potential losses from an existing position. For example, if you hold a long position in a particular stock, you could hedge that position by taking a short position in a related stock or index. The purpose of hedging is to reduce the potential impact of market volatility on your portfolio. By hedging your positions, you can protect your portfolio against potential losses, while still maintaining exposure to your desired assets. There are several different hedging strategies that you can use when trading. One of the most common strategies is the use of options. Options contracts give you the right, but not the obligation, to buy or sell an asset at a specific price before a specific expiration date. By buying or selling options contracts, you can protect your portfolio against potential losses or profit from market movements. Another common hedging strategy is the use of futures contracts. Futures contracts are agreements to buy or sell an asset at a specific price on a specific date. By buying or selling futures contracts, you can lock in a price for a particular asset, thereby reducing your exposure to price fluctuations. It's important to note that hedging can be complex and requires a good understanding of the underlying assets and markets. Additionally, hedging may not always be effective in protecting your portfolio against losses, and may also limit your potential profits. At Relockium, we believe that hedging can be a useful tool for managing risk in trading, but it should be used in conjunction with other risk management strategies, such as stop losses and diversification. By combining different risk management strategies, you can create a comprehensive risk management plan that helps protect your capital and maximize your potential profits. Welcome back to Relockium's Risk Management and Trading course. In this chapter, we'll be discussing leverage and how it can be used to magnify potential profits as well as increase risk. Leverage is the use of borrowed money to increase the potential returns on an investment. In trading, leverage is commonly used to increase the size of a position without having to put up the full amount of capital required to open the position. For example, if you wanted to buy 100 shares of a stock that is trading at $50 per share, you would need to put up $5,000 in capital. However, if you used leverage of 2 to 1, you would only need to put up $2,500 in capital, as your broker would loan you the remaining $2,500. While leverage can be a powerful tool for increasing potential returns, it also comes with increased risk. If the trade goes against you, the losses will be magnified as well. It's important to understand the risk involved with leverage and to use it responsibly. One of the key factors to consider when using leverage is the margin requirement. Margin is the amount of capital that you need to put up in order to open a leveraged position. Different assets and brokers have different margin requirements, and it's important to understand those requirements before using leverage. Another important factor to consider is the leverage ratio. The leverage ratio is the amount of leverage used relative to the amount of capital invested. For example, if you used $2,500 in capital and borrowed $2,500, your leverage ratio would be 2 to 1. The higher the leverage ratio, the greater the potential returns, but also the greater the potential losses. It's also important to consider the potential impact of leverage on your whole portfolio. If you use too much leverage, a single losing trade can wipe out a significant portion of your capital. Therefore, it's important to use leverage conservatively and to always consider the potential downside. At Relockium, we believe that leverage can be a useful tool for increasing potential returns, but it should be used in conjunction with other risk management strategies, such as stop losses and position sizing. By combining these different risk management strategies, you can create a comprehensive risk management plan that helps protect your capital and maximize your potential profits. Market volatility refers to the speed and magnitude of price movements in the market. Volatility can be caused by various factors such as economic events, political developments, and market sentiment. Volatility can be both an opportunity and a risk for traders. While high volatility can offer the potential for high returns, it also increases the risk of losses. Therefore, it is important for traders to understand how to manage risk in volatile markets. Understanding volatility. The first step in managing risk in volatile markets is to understand what volatility is and how it impacts trading. Volatility is measured by various indicators, such as the VIX Volatility Index and the ATR, Average True Range. These indicators can help traders gauge the level of volatility in the market and adjust their trading strategies accordingly. Traders should also be aware of the factors that can cause volatility, such as economic data releases, central bank decisions, and political events. Setting stop losses. Setting stop losses is one of the most important risk management tools for traders. Stop losses allow traders to limit their losses on a trade by automatically closing the position when the price reaches a certain level. In volatile markets, setting stop losses is particularly important as the price can move rapidly in either direction. Traders should set stop losses based on the level of volatility in the market, and they should also consider the risk-reward ratio of the trade. Scaling in and out of positions. Scaling in and out of positions is another strategy that can be used to manage risk in volatile markets. Scaling in involves entering a position gradually with small amounts, rather than entering all at once. This strategy can help traders avoid taking on too much risk at once in a volatile market. Scaling out involves exiting a position gradually with small amounts, rather than exiting all at once. This strategy can help traders lock in profits and reduce risk in a volatile market. Trading with the trend. Trading with the trend is a strategy that can be used to manage risk in volatile markets. When the market is volatile, it can be difficult to predict the direction of the price movement. Trading with the trend can help traders identify the direction of the price movement and take advantage of it. Traders should use technical analysis tools such as trend lines, moving averages, and indicators to identify the trend and enter positions in the direction of that trend. Using volatility-based strategies. There are various volatility-based trading strategies that traders can use to manage risk in volatile markets. These strategies include trading breakouts, trading range reversals, and trading with volatility-based indicators such as Bollinger Bands and the ATR. These strategies can be effective in a volatile market as they are designed to take advantage of price movements and volatility. Avoiding overtrading. Overtrading is a common mistake that traders make in volatile markets. Overtrading can lead to taking on too much risk, entering trades that are not based on solid strategy and emotional decision-making. Traders should avoid overtrading by sticking to their trading plan, setting realistic goals, and avoiding the temptation to trade too frequently. Keeping emotions in check. Finally, it is important for traders to keep their emotions in check when trading in volatile markets. Emotions such as fear and greed can lead to irrational decision-making, which can increase the risk of losses. Traders should use techniques such as mediation, visualization, and journaling to help them manage their emotions and maintain discipline in volatile markets. In conclusion, managing risk in volatile markets is essential for traders who want to succeed in trading. By understanding volatility, setting stop losses, scaling in and out of positions, trading with the trend, using volatility-based strategies, and avoiding overtrading, you can create a comprehensive risk management plan that will help you protect your capital and maximize your potential profits. Welcome to Relockium, the most trusted online trading academy with thousands of students around the world. In the last 5 years, we have taught people around the world how to trade safely and how to get the most out of the stock market with the least amount of risk. Thanks to our experience in real-world trading, we have developed the most efficient formula for building a professional trader in the shortest period of time, with the highest chance of success. Don't take our word, ask our students around the world. More than 86% of them are now working as professional traders and experiencing great success. The main principle of our educational program is the instant practical application of newly gained knowledge. This allows us to prepare novice traders, not only educationally, but also psychologically, which, according to our many years of experience, is an equally important factor in achieving success. Today, we will be taking you through a brief overview of this course. The goal at the end of this program is to get you familiar with the stock exchange market, as well as with the crypto market. You will learn about all the opportunities and risk in these markets, and how to get the most from every situation that could possibly transpire, both in recession times and in growth times. We will also tell you about the latest evolving financial technologies, such as DeFi and NFT, and how they can change the future of the financial industry. To meet our goals, it is crucial we figure out what is valuable information and what you just do not need to know. So we will cut away all the jargon and only provide you with the essential tools along the way. In the first module, we will give you an initial glimpse at the US markets and its history. We will have a more general look at the S&P 500, the Dow, and the Nasdaq. To be a successful trader, you need to fully understand what technical analysis is, and we'll dive right into it. For example, you will learn what Japanese candlesticks are, and how they are another fundamental part of trading. We will also dissect the markets and the stocks to help you understand the correct approach to trading. We will also teach you all that you need to know about the crypto market, starting from the history and the development of cryptocurrencies up to the technology behind the blockchain. Additionally, you will learn about the new evolving technologies in the crypto industry, such as DeFi and NFT. We will go over some examples of people who have gotten rich using cryptocurrencies, as well as examples of people who have gone broke, so that you can learn from all of their mistakes. When you finish this course, you will have all the fundamentals you need to fully understand the markets. Your financial IQ will grow significantly, and you will be ready to become a trader who makes money for a living by trading professionally. You will learn all about these topics and much more in the next lessons. See you soon in our first lesson about the stock exchange. Welcome back to our course and to your first practical lesson. In today's lesson, we will learn about stock market exchanges. Knowing the basics of how the stock markets work can help make you a better investor and trader. It is important to understand why your investments can be bought and sold at a second's notice. Why are there so many people trading on the stock exchange, and how you can also take part and profit from trading. After this short lesson, you will understand the basic principles of the stock exchange. Going beyond the underlying business fundamentals, you will see that the market works like an auction system, where prices are governed by supply and demand. So, let's begin with the basics. What are stock exchanges? A stock exchange acts as a market where stock buyers connect with stock sellers. In other words, this is a market where some people or companies sell their products in the stock market. The products can be stocks, commodities, bonds, ETFs, and much more. Don't be afraid if you don't yet understand what these things are. These are just names for different products on the stock market exchange. On the other side of the market, there are buyers who want to buy in order to later sell the product and make a profit. Like in any other market, the sellers try to set the price on their product as high as possible, and the buyers want to buy as cheap as possible. Then the trade between them begins. There are many stock market exchanges around the world where stock and other products can be traded. You have probably heard about some of the more famous exchanges, such as the New York Stock Exchange and the Nasdaq. So, how can you get access to the market and begin to trade? Investors must carry out the transactions of buying or selling stocks or other products on the market through a broker. In a nutshell, a broker is simply an entity licensed to trade stocks on a stock exchange. Today, we are living in a digital age, and most of the brokers are online brokers that process the entire transaction electronically. So basically, you can work from anywhere. All you need is a computer or mobile phone and internet connection. How can you begin to trade? Today, it's very simple. After choosing your broker, you can begin to trade. Simply contact the Relockium experts from our trading school to assist you with finding the right broker. After you've set up your trading account, you're ready to begin. Here's the simplified version of the trading process. First, go to the trading platform. Here you can see all of the available products for buying. For example, stocks. You choose what stock you want to buy and how many shares you want. Your broker relays your order to the exchange, and a market maker sells you shares at the current market price. The shares are then delivered to your account. Eventually, you can sell them back for a profit once their price goes up. This whole process only takes a few seconds, and the money from the sale is delivered immediately to your account. Please note that usually you will pay a small fee for every buy and sell order. This is how the brokers get their payment for providing you with their service. Welcome back to our course. In today's lesson, we will learn about what an investment product is and examine some of the most popular products you can trade on the stock market exchange. By the end of this lesson, you will know the difference between stocks and bonds. You will understand what are mutual funds and ETFs, and you will also be able to tell why index funds are considered to be one of the best risk-reward investments on the stock market. Starting from the basics, what is an investment product? An investment product is the umbrella term for all the stocks, bonds, options, derivatives, and other financial instruments that people put money into in the hopes of earning profits. A wide range of investment products exist within the investment universe to help investors meet short-term and long-term investment goals. Overall, investors purchase investment products for their capital appreciation potential and income-paying distributions. Let's take a look at the most popular investment products on the market. These are the products you probably will use during your first year of trading. Stocks. When you invest in a stock, you become one of the owners of a corporation. Stocks represent ownership shares, also known as equity shares. Whether you make or lose money on a stock depends on the success or failure of the company. Companies issue stock as part of a capital-raising regime which funds the operations of the company. Stocks can be classified in various categories and may also offer dividends, adding an income payout component to the investment. If the company does well and makes money from the products or services it provides, you expect to benefit from that success. Bonds. Bonds are one of the most well-known fixed-income investment products. A bond is a loan an investor makes to a corporation, government, federal agency, or other organization in exchange for interest payments over a specified term, plus repayment of principal at the bond's maturity date. Bonds are called fixed income securities because many pay you interest based on a regular, predetermined interest rate, also called a coupon rate, that is set when the bond is issued. Similarly, the term bond market is often used interchangeably with fixed income market. Mutual funds and ETFs. Investment funds pool the money of many investors and invest according to a specific strategy. Funds can offer diversification and professional management, and they can feature a wide variety of investment strategies and styles. Mutual funds are a popular way to invest in securities. Technically known as an open-end company, a mutual fund is an investment company that pools money from many investors and invests it based on specific investment goals. The mutual fund raises money by selling its own shares to investors. The money is used to purchase a portfolio of stocks, bonds, short-term money market instruments, other securities or assets, or some combination of these investments. Every share represents an ownership slice of the fund and gives the investor a proportional right based on the number of shares he or she owns to income and capital gains that the fund generates from its investments. Exchange-traded funds, ETFs, combine aspects of mutual funds and conventional stocks. Like a mutual fund, an ETF is a pooled investment fund that offers the investor an interest in a professionally managed, diversified portfolio of investments. But unlike mutual funds, ETF shares trade like stocks on stock exchanges and can be bought or sold throughout the trading day at fluctuating prices. Index funds. An index fund is a portfolio of stocks or bonds designed to mimic the composition and performance of a financial market index. Index funds seek to match the risk and return of the market based on the theory that in the long term, the market will outperform any single investment. For example, S&P 500 index funds are mutual funds or exchange-traded funds, ETFs, that passively track the Standard & Poor's 500 index. This index represents approximately 500 of the largest U.S. companies, as measured by market capitalization. This means that the largest companies receive the highest allocation in the index. Legendary investor Warren Buffett has recommended index funds as a haven for savings for the later years of life. Rather than picking out individual stocks for investment, he has said it makes more sense for the average investor to buy all of the S&P 500 companies at the low cost that an index fund offers. That's all for today. We hope that you now better understand the jargon used in the industry and that you have learned what your options are for trading. In the next lesson, we will learn about more complex tools that are used by professional traders. Welcome back. It is good to see you again. Now that you understand the basic investment instruments on the stock market exchange, today we will take a closer look into more complex tools. Don't be afraid if you do not understand everything we will learn today. These are very complex tools that are only used by experienced professional traders. The goal of this lesson is only to get you familiar with these tools so that you will better understand industry jargon. Examples of this jargon include derivatives, options, commodities, and algorithmic trading. Let's begin with a simple tool that is used by professional traders. Trading commodities. A commodity is a basic good used in commerce that is interchangeable with other goods of the same type. Traditional examples of commodities include grains, gold, beef, oil, and natural gas. For investors, commodities can be an important way to diversify their portfolios beyond traditional securities. Because the prices of commodities tend to move in opposition to stocks, some investors will rely on commodities during periods of market volatility. Commodities that are traded are typically sorted into four broad categories: metal, energy, livestock, and agricultural. For investors, commodities can be an important way to diversify their portfolios beyond traditional securities. In the most basic sense, commodities are known to be risky investment propositions because their market supply and demand is impacted by uncertainties that are difficult or even impossible to predict, such as unusual weather patterns, epidemics, and disasters, both natural and man-made. There are a number of ways to invest in commodities, such as futures contracts, options, and exchange-traded funds, ETFs. Options. Options are tradable contracts that investors use to speculate about whether an asset's price will be higher or lower at a certain date in the future, without any requirement to actually buy the asset in question. In other words, options are contracts that give the purchaser the right, but not the obligation, to buy or sell a security, such as a stock or exchange-traded fund, at a fixed price within a specific period of time. Options can help investors manage risk, but buying and selling these options also involves risk, and it is possible to lose money. As with any other type of investing, it is best to educate yourself thoroughly before you begin. You may also consider utilizing online simulators to get a feel for how options trading works before you try out the real deal. Algorithmic trading. An algorithm is defined as a specific set of step-by-step instructions to complete a particular task. Whether it is a simple yet addictive computer game like Pac-Man or a spreadsheet that offers a huge number of functions, each program follows a specific set of instructions based on an underlying algorithm. Algorithmic trading is the process of using a computer program that follows a defined set of instructions for placing a trade order. The aim of the algorithmic trading program is to dynamically identify profitable opportunities and place the trades, in order to generate profits at a speed and frequency that is impossible to match by a human trader. Given the advantages of higher accuracy and lightning-fast execution speed, trading activities based on computer algorithms have gained tremendous popularity. All trading algorithms are designed to act on real-time market data and price quotes. Algorithmic trading software is costly to purchase and difficult to build on your own. Purchasing ready-made software offers quick and timely access, while building your own allows the flexibility to customize it to your needs. Before venturing into algorithmic trading with real money, however, you must fully understand the core functionality of the trading software. Failure to do so may result in big losses. Derivatives. Derivatives are investment products that are offered based on the movement of a specified underlying asset. Put or call options on stocks and futures based on the movement of commodities prices are a few of the market's leading derivative investment products. There are also futures and other customized investment products that allow investors to speculate on price movements or move risk between parties. The risk-reward equation is often thought to be the basis for investment philosophy, and derivatives can be used to either mitigate risk, hedging, or they can be used for speculation, where the level of risk versus reward would be considered. For example, a trader may attempt to profit from an anticipated drop in an index's price, such as the S&P 500, by selling or going short the related futures contract. Derivatives used as a hedge allow the risk associated with the underlying asset's price to be transferred between the parties involved in the contract. Derivatives are complex investment products, so a certain level of market knowledge and experience is required. Okay, did you survive so far? Good. Don't be afraid if this lesson was a little difficult. It's okay. You can always watch it again later. In the next lesson, you will learn about technical analysis and how to predict if your investment will go up or down. Today is going to focus on trading psychology. First of all, we're going to be talking about the secret to success and then general trading guidelines. We'll follow that up by learning from experience and working through stages of development, taking you from an amateur trader to a professional. What are the steps that will get you there? And how do you deal with losses? To succeed, you really need to have a great understanding of what it means to deal with ups and downs regularly. What does it mean? Many traders out there think that having a great technical ability will ensure they are able to define a good entry and exit point. In reality, that's only a small percentage of what a successful trader goes through. Secondly, it is important we will take a look at financial management, as it accounts for a portion of your success as well. In short, technical entry and financial management have minimal influence on one's success. What really makes a difference is a strong psychological ability. Usually, it accounts for the majority of the effort that goes into trading. It's not always about the technical ability of being able to analyze technical points in a chart, or the entry or exit, or managing the money. The psychological aspect of trading is what's crucial. However, most traders primarily focus on technical abilities. The big part of being a trader is being able to handle trading and the pressure on the market. Common human psychology flaws when trading really break down into three common denominators. Despite new information arising, traders change their views really slowly. They often sit there and dwell on it. As a result, they act too slowly to make a difference when trading. We credit ourselves a lot of times with success, but we blame failures on events or external factors. Many traders out there have excessive self-confidence and tend to overhype their abilities. Especially when starting out, they often think that they're better than the markets, but they haven't really figured it out yet. They assume they really know what they're doing. However, that's not the case. Again, you may have a slight edge on the market, but you'll never figure the market out. You'll never really be able to answer the questions of why something happened. You have to psychologically be able to handle yourself when you're trading. A loss resulting from correct behavior is not really that painful. It's just simply the lack of luck. And realistically, lack of luck is also just an inseparable part of day trading. It's just part of what we do. It happens to everyone, everywhere around us. We have all had it happen, where we got into a stock and it didn't end up going the way we thought. Let's move on and talk about general trading guidelines. In general, how do you go into a trade? What exactly do you need to do when you're getting into that trade? And what do you look for while trading? The answer is, the trend is your friend. And you've heard this through many books that you've read, and many people that you talk to when you're day trading. You have to be able to follow the trend of the stock in order to be able to follow the trend of the market. When the market is trending up and the stock is trending up, you don't want to be shorting the stock. You want to be riding the trend higher, riding the stock higher, and that's called trading with a trend. Secondly, you have to enter at a clearly defined technical level. So again, we talked about this in earlier lessons, where you're looking at those breakouts, those breakdowns, and those reversals that have clearly defined technical levels that you're going to be trading around. Also, the most important part is exiting losing stocks at your stop loss, identifying where you're taking your profit, where your entry is, and also defining that stop loss on each and every trade, and adhering to that stop loss is very important. We want to teach you to be able to trigger your stop loss and get out of the stock without losing your account. And we don't want you to also cut yourself off short and exit the winning stocks too quickly. That's why we suggest taking partials along the way. Remember what we talked about in several charts back? That first target price is where you come out of a certain percentage of your trade. It's all up to you. Your comfort level is imperative. We don't want you to be getting in over your head by taking trades with too many shares, causing you to panic in that trade. We want you to be cool, calm, and collected during trading. And the way you do that is to make sure that your share size is manageable. Also, you should avoid trading during the first and last minutes of the day. Having your day cleaned up well in advance of that closing bell at 4 o'clock is a vital part of your routine. Furthermore, we should also be trading, not at the very first candle or that first minute or second of the day. We want to have the market breathe a little bit. You should take a look at the market and understand the direction or the trend of the market before you're placing any trades. Taking what the market gives you on a day-to-day basis instead of forcing targets is something to be learned and implemented. Plus, don't trade according to your P&L. I often train traders across the globe by telling them to take their P&L and hide it, because the more that they're fixed on what their profit and loss are, the less that they're going to be focused on the chart and the technicalities of trading. Now, how to learn from your experience. How do you get better and progress up the ladder to become a better trader? Well, one of the ways to do this is by journaling your trades. And doing this is very important to do on a day-to-day basis. Having your journal with trades helps you learn from your mistakes as well as from your wins. You have to learn theory and put it into practice to reinforce the learning. Lastly, the most important thing and the biggest key there is your discipline or your thought process during that trade. Why did you take that trade? Sure, you may have had the entry, the exit, and the stock, but I want to know why the trade was taken and what the intention and feeling behind it was. Those are the keys when reviewing my trades regularly. To determine the error of each trade, we have to look at those and see if any reoccurring things are happening, and make a conscious attempt to take those things out of our trading repertoire. It is important that you get familiar with your hatred of loss and accept it. Turn it into the driving force behind your learning and trade journaling. Now, let's transition and talk about the stages of development between an amateur to a professional trader. These stages of development are broken down into a few categories. When you're an amateur, when you're just starting out, you most likely want to get rich quick. You see many traders on social media, or traders that you may know doing a great job every day. Well, I'm here to tell you these professionals have done this over a long period of time. It's just like mastering to fly an airplane. You can't read a book on flying an airplane, get behind the stick, and all of a sudden take off, and you're a great pilot. It just doesn't happen that way. When you're trading, it's all about screen time. The more screen time you have, the more practice you have. The more times that you're out there journaling your trades, the better you're going to be over time. Focusing on the correct way is the correct practice of trading that will lead to long-term success. Professionals are not afraid of risk. They're trading the proper stocks, and they know how to manage and contain what they're doing. Professional traders also view the market as a game of probabilities, understanding that not every trade is going to be a positive experience. But we know how to manage the feelings behind winning trades and losing trades because it's all part of the business. The objective is long-term survival. It's about not taking on too much risk at once, so that you'll be here tomorrow, the next day, the next week, the next month, and the next year. It's all about survival. The second objective really is consistency and accumulation of capital. With a consistent accumulation of capital, you'll work up that percentage over time. Those profits will compound, and you'll be seeing the light at the end of the tunnel over time. And the third and last objective is making high profits. So not only do you have to survive, not only do you have to be consistent, but you also need to be making high profits over time. We talk all the time about how positive traders win, but what happens when you have a loss? What happens when you have a losing day? This is going to happen, and these are the most common ways that traders lose. Not entering a trade at a valid technical level and ignoring technical entries and exits, profit losses, and the real stop losses is one way that you can lose. That's one of the common ways that you can lose by ignoring those key points. Secondly, ignoring the charts and the technical patterns. When you see a chart, whether it's the entry or exit, a breakdown or a breakout, you ignore those things, going rogue, and start pushing the button. Also, trading through boredom or overtrading is another common way to go in the downward direction. When you're bored, go do something else, such as working out, eating, or doing something else other than trading. Often, when you're bored, you might be clicking that button, putting on more trades than you need to, and that's a solid sign to lose a trade. We don't want you to be in that situation. Instead, we want you to make money from the market, pull it out, and end your day. Also, exiting the trade too early can be harmful as well for your long-term trading success. Again, that's why we have profit targets established. When you get into the trade, as we spoke about before, you're looking at a stop loss and profit targets along the way. And as you get close to your profit target, you can start taking your profits along the way, so that you don't have to wait specifically for that level. As you get close to that level, you're taking profit targets, and you're taking some of your trade-offs and allowing the rest to run. Focusing on the fundamentals of the trade is vital. Try to avoid trading based on what you think should happen. Instead, focus on what's actually happening. The trend is your friend. Follow the stock market and the stock, and when the stock is moving higher, take the stock for a long position, along with the trend of the overall market. Don't try to fight the trend. Lastly, one of the common mistakes that I see all the time is traders averaging down. It results in a loss, and it's also twice as big. That's why we have stop losses when the stock goes against you. I want you to get out of the stock and not start thinking it's going to turn around. In this final section, we're going to talk about how to deal with losses. Trading is all about the probabilities out there. You have to accept that your strategy is profitable based on the average of all trades taken, not just one. Over time, as you look at your trading throughout the month, we can see the overall theme of our month. Was it a profitable or a losing one? It is common we have some bumps and losses along the way, but overall, when we have a green month, a green week, or a green day, we can't forget that we've had some red days or red times in that month. However, we measure ourselves monthly and make the conclusions from there. Secondly, remember that learning never ends. It's just like being a doctor. It's an ongoing process that never stops. Learning each and every day, you can pick up something from the Wall Street Journal, from television, from the trading room, and all of these things will add up, resulting in you being a better trader. Know your loss limits and be cautious to not exceed those. Also, there's a strategy called sitting on your hands, which is one of the best ways to avoid a loss. Remember, traders, you can go longer stock, you can go short on a stock, and you can sit on your hands and avoid the stock altogether. That's one sure way to deal with losses over time if you find yourself in that rut. If you find yourself overtrading or trading with a loss, sit on your hands, take a breath, step away, and just look at the market and understand where you've been. Looking at your journal, looking at your trades, and being able to learn from what you have been doing recently. Losses are part of the package. It's part of paying your dues to becoming a successful day trader. I would like to thank you for joining me during this lesson, and I look forward to seeing you in the next one.